There is absolutely no doubt about it. September is historically the worst month in the stock market. Since 1950, virtually every single month, on average, the market is positive, with a slight exception of February. And then we have September, which on average is down 0.68%, a stark difference compared to these other months. Now, so far, 2025 has been a wild ride in the market. If we jump over to forecaster.biz, which by the way, you can check out at the link in the description, we can see year to date, the S&P 500 is already up by about 10%. And if you bought the dip during the tariff lows, you'd be up well over 20%. But here's what's so interesting about this. Yes, the S&P 500 is up a little bit over 10% year to date, but if you missed April 9th, which was the best day of 2025, you'd only be up 1.2%. This is why it can be so dangerous when you try to time the market. There's a lot of people whose investments have not done well in 2025 because they panic sold during the tariff dip. And I'm starting to see that same sentiment echoed because of how bad September has historically been. But this September is not your typical September. To start, just a couple of weeks ago, Jerome Powell stated that they're expecting to cut interest rates on September 17th. In fact, we're now pricing in about a 95.6% chance that we do see an interest rate cut. So we're entering an interesting economic environment. And now on top of this, Fundstrat analyst Tom Lee is stating that he expects September to actually be an up month. If we look at his statement, he said it's because the Fed's been on hold all year and then they've been cutting in September. That's only happened 2 other times in the last 50 years, 1998 and 2024. And in both instances, the S&P 500 showed positive performance, rising 3.3% on average. Now, with that being said, historical data since 1950 shows September is typically only up about 47% of the time. And we can see this is definitely true when we actually look at the seasonality charts for the S&P 500. In the red, we have the current year, and in the blue, we have the past 5 years. And what you can see is right here, yes, that we typically see a sell-off in September. What's interesting is if we stretch this timeline over a 15-year time period, you can still see we have that September sell-off. If we add a 30-year timeline, again, we still have that September sell-off. So yes, September's an interesting month, but with rate cuts ahead, there's certainly opportunities in the market. So let's look at 3 different dividend stocks that are set to benefit from interest rate cuts. Now, starting out, we have the REIT. That's the monthly dividend payer that you're probably familiar with. It gets a lot of coverage, and that's Realty Income Corporation. Now, the past 5 years have not been good for this REIT. It's actually down by about 7%. But what's also interesting is if we look at the dividend payouts during that time, the entire time, they've been growing the amount they pay out in dividends. Now, historically speaking, Realty Income has been susceptible to the September sell-off as well, whether we look at it over a 5 or even 7-year time period, or even a 30-year time period as well. But here's why Realty Income is interesting in particular. If we jump over to dividendology.com, which by the way, this is typically where I put out my best work. So if you aren't a member over there, you should definitely check it out at the link in the description. But I recently put out a report on REITs. And there's a lot of really important information in this article. But simply to start, look at the historical return of REITs. REITs are a way out of favor asset class right now, but that has not historically been the case. In fact, we can see in the 90s, they returned about 13.5%, 2000s, 14.2%, 2010s, 13.2%. That's an average annual total return of 12.4%. But meanwhile, from 2020 to 2024, the returns have been about 5.5%, which obviously is way below the historical norms. Now, why has this been the case for the 2020s? Well, to put it simply, it's the interest rate environment that we've been operating in. Higher interest rates make those big dividends that REITs pay out less attractive, at least on a risk versus reward perspective. But here's where this gets even more interesting. Look at REITs from a valuation perspective. What we're looking at is U.S. real estate versus U.S. equities earnings multiple spreads. So what we can see from this purple line, this is the median multiple spread with REITs versus US equities. And historically speaking, REITs have traded at a bit of a discount, about a negative 0.6% discount to equities. But look at what the discount is right now. Negative 6.5%. REITs are trading at an absurd discount to equities right now. And historically speaking, anytime REITs have traded at a discount of negative 2x or greater to US equities, the average forward returns have been very impressive. The 1-year returns, 25%, 2 years, 18.7%, 3 years, 13.9%. In each of these instances, it outperformed the S&P 500. Now, this doesn't mean every REIT is poised to grow. There's a lot of bad REITs, there's plenty of good REITs. So how do we separate the good from the bad? Well, on a very high level, there's actually a way to do this. It's simply looking at the sources of their returns. What does that mean? Well, as investors, we have to understand our investment sources of returns. And when it comes to REITs specifically, there's three sources of returns. Earnings growth, which in the case of REITs would actually be AFFO per share growth. We have dividends, and then we have multiple expansion/contraction. So what's been happening with realty income? Well, like we've already seen on Forecaster, they've continued to grow and pay out dividends over the last 5 years despite their underperformance. And in fact, if we look at the dividend yield, it's currently yielding around 5.52%. That's an attractive yield. So we know one of the major sources of returns has been dividends. But what about the other sources of returns? Most importantly, have they been growing AFFO per share? Well, look at what's happened since 2018 through 2024. Every single year, we can see realty income is growing the most important metric for REITs, AFFO per share. Again, we have to remember, dividends are paid out of AFFO per share for REITs. This is like if a more typical stock was growing earnings per share or free cash flow per share. But despite realty income growing AFFO per share, we can see the average price over the past few years has continued to go lower. In 2019, they were at $72 per share. The next year, $60. A few years later, all the way down to $55, $56 per share. So what's the end result of them growing AFFO per share while the average share price declines? It means the valuation multiple is getting much more attractive. Historically, we can see realty income was trading between about an 18 to 21x price to AFFO multiple. Investors were willing to pay a premium for this REIT, but as we entered a higher interest rate environment, we can see that multiple went lower and lower. So what this means is fundamentally, realty income has continued to grow stronger despite the share price going down. The sell-off has been purely due to multiple contraction, and this is a good sign. That's what we want to see. Now, here's the mistake a lot of people make when analyzing REITs like realty income, especially as it comes to interest rates. To start, realty income has a good balance sheet. They have good credit ratings. Moody's has them as A3, S&P Global, A-. That's typically one of the highest you'll see for REITs. But look at the fixed rate percentage for their debt profile. It's sitting at 95%. What does this mean? Well, it means the interest rate on this debt is locked in and it does not change regardless of whether market interest rates rise or fall. Now, this is great because it protects from rising rates, but in a case where rates are declining like we're about to see, they're not going to see as much benefit. So why would a different interest rate environment impact realty income? Well, again, everything has to be looked at through the lens of opportunity cost. There is a direct correlation between things like interest rates, the US 10-year Treasury, and realty income. When risk-averse investors can get decent risk-free returns, for example, I know public.com, I have a link to them in the description, you can get a 4.1% APY right now. You can get a 4.1% yield on your high yield savings account. So if you can get a risk-free 4.1% return, a lot of investors don't turn to REITs for yield anymore. So no, changes in interest rates will not directly impact REITs like realty income who have 95% fixed rate debt, at least from a fundamental perspective, but it will greatly change how investors actually view the REIT from an opportunity cost perspective. The yield on high yield savings accounts are going to be going down, making realty income more attractive. Next up on our list, we have Lowe's. Now, historically speaking, Lowe's has been a great dividend growth stock. They've been growing those dividend payments at a very high rate over the past decade, and they've seen market-beating returns over the past decade as well. If we look at the past 10 years, the stock is up over 284%, but in the last year, only up by about 6.14%. Now, what's interesting about Lowe's is if we look at the share price movement since the beginning of the year, look at it year to date, up about 5.5%. We can see it dipped when we had the tariff scare, and it didn't really recover until we had the news surrounding the potential interest rate cuts from Jerome Powell. And after we got that news, this stock absolutely shot up. If we look at just the last month, it's up 11.43%. So you might be thinking, doesn't it seem a little bit too late to be buying before interest rate cuts? I don't think that's the case with Lowe's yet, and I'll show you why here in just a moment. To start, Lowe's has typically outpaced the broader indices when we have rate cut cycles. For example, when the Fed cut in 2024 in September, if we zoom out a little bit, it saw a period of time where it actually outperformed the market. Now, what has September historically looked like for this stock? Let's look at the seasonality. If we look at the 20-year chart, we can see typically September has seen a little bit of a pullback for this stock, but not nearly to the degree of a lot of these other companies we've been looking at. Now, one of the things you'll notice is if we look at sales for this stock annually over the last few years, when we went into a very low interest rate environment, going from 2020 to 2021 and 2022, sales exploded. They went from about $72 billion to $89 billion the following year and then $96 billion. And yes, some of this was spurred by the fact that a lot of people were staying home and taking on home improvement projects during that time period. But since then, we've actually seen sales start to decline. In fact, in 2024, it came in at about $86.38 billion. But here's the good news for Lowe's. If we look at their recent earnings report, they did give us some full year guidance. To start, we can see they actually increased their full year 2025 outlook to around $84.5 to $85.5 billion, which is a little bit higher than we saw previously. Now, you might be asking yourself, but what about Home Depot? Is that the better opportunity? Well, let's talk about these two stocks from a valuation perspective for just a moment. To start, if we look at the PE ratio for the trailing 12 months, Lowe's is sitting at 21.25, meanwhile Home Depot quite a bit higher at 27.65. In fact, Home Depot's had a higher PE ratio now for the last 2 or 3 years. Now, at times this can be justified if a company is expected to grow earnings at a higher rate, but if we looked at the projected growth rates for Lowe's, the 4-year EPS CAGR is projected to be 8.3%, while Home Depot is projected to be 6.12%. So from a valuation perspective, I think Lowe's makes a lot more sense. Lowe's is obviously a lower yielding stock at about 1.78%, but the dividend growth has just been phenomenal from this company over the past decade. And then we come to JP Morgan, a stock in my portfolio that has more than doubled. And what a run they've been on in the last 5 years, up around 190%, and even just this year alone in 2025, already up nearly 25%. Now, if we look at the seasonality for JP Morgan, let's go ahead and add that 30-year chart, and we can see there's not typically as much downward when it comes to September and seasonality with this stock, unless you look at it on a 30-year time period. Now, bank stocks in a lowering interest rate environment are extremely interesting. It's great to study these types of investment cases because there's a lot of moving parts. Let me show you what I mean. To start, we have to discuss at their core how do banks make money. For the most part, they take in loans and give out deposits, and they make money on the spread. So if we simplify it as much as we can, if they're giving out loans and getting 4% interest, and then on the deposits they're giving out 2%, their net interest margin would be around 2%. That's what they're making. So the net interest margin is a key metric to study. Now, at first glance, that would make you think if rates are going lower, that would mean that the net interest margin is going to lower, meaning they're bringing in less money. So let's see how much of those loans are fixed rate versus variable rate. If you go through their Form 10K in 2024, we can see right here, loans due after 1 year at fixed interest rate. Add these numbers up together right here after 1 through 5 years, and we come to about $37 billion. The total amount of loans at a fixed interest rate, meaning it's not going to change. What about at variable interest rates? We can see it's significantly higher. In fact, if we add all this together, it's about $280 billion. So because so much of JP Morgan's loans are variable rate, this makes JP Morgan's earnings very sensitive to Fed policy. And in fact, what's likely to happen is in the short term, they could bring in less net interest income. So that's not good news for JP Morgan. But again, this doesn't paint the whole picture. There's a lot of moving parts. For example, on their Form 10K, if you go to slide 20, they list out some of the risks of investing into JP Morgan, just like all Form 10Ks do. And one of the things that they make note of, higher interest rates can also negatively affect the payment performance on loans within JP Morgan Chase's consumer and wholesale loan portfolios that are linked to variable interest rates. They're talking about what we just looked at. Basically, if the borrowers of those variable rate loans are unable to afford higher interest payments, those borrowers might reduce or stop making payments altogether, causing JP Morgan to incur losses. That's one of the things we have to understand that's actually good news about rates being lowered. On top of this, there are other items when it comes to bank stocks in particular. For example, the demand for loans increases, so even if the net interest margin is decreasing, they're doing more volume. On top of this, with lower rates, we see more trading and investment banking. We see the credit quality of their portfolio continue to improve. They become less risky. So yes, banks are complicated, and there's a lot of moving parts, especially when there's any type of interest rate changes. But lowering interest rates isn't necessarily always bad for bank stocks, especially in the long term. And fortunately for JP Morgan, they have a track record of performing very well in both environments. If we look at how this stock has performed in the last 10 years, they're up 387%. And this isn't all due to multiple expansion. During this time, they've been able to achieve very high ROTCE. This stands for Return on Tangible Common Equity. It's basically telling us how effective a bank is at generating profits relative to its tangible common equity. On top of this, they've been able to continue to grow the key metric for banks, tangible book value per share. We can see quarter after quarter, this is growing at a very healthy rate. So while JP Morgan is trading at an all-time high, they're still in a great position, and they're definitely benefiting from economies of scale. So yes, September is typically the worst month for the S&P 500, generally speaking, but these rate cuts are going to change everything. The market as we know it is changing, not just for companies that have either fixed or variable rate debt, but for investors who are viewing the market from an opportunity cost perspective, looking at it from a risk versus reward perspective. And understanding how each of these companies is differently impacted by lowering rates will definitely help your investment decisions. So go ahead and let me know what you think of these companies down below. Again, be sure to check out forecaster.biz at the link in the description down below. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.